Get something like this. Huh? We'll have to bring it today only, because from tomorrow we'll require it again, no? Okay. See, we'll start now. Started. Huh? No, but he was not knowing, no, that this thing is not working. I showed, then he told me. If he did not wanted to give, he would not have given only. So, I'll start now. And see, bring one coffee right now and go out and find out this thing. If you get this thing, bring this thing. Otherwise, a similar thing which I have. Okay, no? And get the reimbursement done from me. I'll pay for that. Okay? Yes. Find it outside if you get it, and do the thing which I have told you. That you don't forget. Bring it, Bring it fast. Okay. See, second part of the chapter. Specific charge. Specific charge. There are certain special type of capital profits or gains arising in special situations. He's elder than you. No, that's okay. Okay, section 45, 1A. Section 45, 1A. So in this section, they are saying that any profits and gains arising on receipt of what? Insurance claim. So sometimes you receive insurance claim. Okay. Why will you receive insurance claim? Because your capital asset was damaged or destroyed as a result of NRFE. So you have one capital asset. That capital asset got getting damaged or destroyed by NRFE. N for natural calamities or riots or civil disturbance. F means accidental fire or explosion. E for enemy attack with or without declaration of war. Because of any of these reasons, your capital asset gets damaged or destroyed. Usually these risks are covered by insurance companies. So maybe to cover these risks, you might have taken a insurance. So something like this happening and your capital asset is getting damaged or destroyed, and fortunately you were covered by what? Insurance. These risks were covered by insurance. So now you are getting any insurance claim. So are you receiving any insurance claim? Yes. And because of that receipt of that insurance claim, the profit or gain will arise. Then section 45(1)(a) will come into existence. And as per 45(1)(a), that profit or gain arising as a result of receipt of that insurance claim will be taxable under the head capital gain. Even that will be taxable as your capital gains. So it will be taxable in which year? The year in which the capital asset is transferred? No. The year in which the insurance claim is received. Usually what happens? Usually the asset gets transferred. In that year the capital gain is taxable. But this is an exception. The capital gain arising in this case will not be taxable in the year of transfer. It will be taxable in some other year. Which year? The year of receipt of insurance claim. Because the year in which you will receive this claim in that year only the profit or gain will be realized. Your profit or gain is not going to realize when the asset is damaged or destroyed. So, the capital gain will be taxable in the year of damage or destruction? No. It will be taxable in the year of receipt of insurance claim. So, for example, if there is an assessee, okay, if there is an assessee who acquired some capital asset, okay, so capital asset, it was acquired in 2009-10. Which year? Previous year 9-10. And it was acquired for 2 lakh rupees. How much? 2 lakh. And you took the insurance of this asset. Okay. Now, while the insurance policy is in effect, it might happen that this asset gets damaged or destroyed due to natural calamities, riots or civil disturbance, accidental fire or explosion, or enemy attack with or without declaration of war. So, for example, this capital asset was damaged or destroyed. Damaged or destroyed in previous year 2023-24. Possible? Now, in this year, the asset is there with you or not there with you? Damaged, destroyed. Asset is not there. Asset ceases to exist. If the asset ceases to exist, meaning your right in the asset is also ceases to exist. There is an extinguishment of right. And by the way, extinguishment of right is a transfer, if you remember the definition of transfer. So, the year in which the asset is damaged or destroyed, this is the year in which there is extinguishment of right, which is equal to what? Transfer. So, when is the transfer taking place? 23, 24. 23. So, what consideration you are going to get for this transfer now? Insurance claim you are going to receive? Is it necessary that you are going to receive that insurance claim in the same year? For example, valuers came, they checked how much loss has taken place, how much loss has happened. Okay, no? So valuers will, they will submit their report to the insurance company, then insurance company will process your claim and they will pass your claim. Then that claim you are going to receive. To claim the insurance amount, it is a tedious task. It is a very difficult task. So, what happened that insurance claim you received in previous year 25-26. Now tell me, how much insurance claim you are going to receive? 2 lakhs. Maybe you bought your asset in 9-10 for 2 lakhs. That same 2 lakh you are going to get. Or the insurance company will assess the value of the asset which is lost. So for example, today at the time of damage or destruction, the value of the asset, the fair market value of the asset was, example, it was 10 lakhs. How much? So the assessors will assess the value near to this amount only, no? It will not be exactly 10 lakh, but it will be near to this 10 lakh only. So just try to understand that assessors will come, they will ask you that what happened, how all these things happen, okay, no, which asset got lost, they will see your insurance papers and everything, they will then assess the value of that asset. They come to know that, okay, the value of the asset is around 10 lakhs. Then they will submit their report to the insurance company and then insurance company is going to pass the insurance claim. Now for example, the insurance company is passing the claim and the claim passed was rupees 9 lakhs. How much? 9 lakhs. Forget about this fair market value. This is just for the sake of reference. Are you getting 10 lakh rupees or you are getting 9 lakh rupees? Asset is going. How much is coming? Asset's cost was 2 lakhs. That asset is going. How much is coming? Isn't it a 7 lakh rupees of gain? If you would have got this gain by selling the asset, would you have paid tax on that? Then why not now? You should pay tax right now also. Because bloody the insurance claim which you are going to receive is more as compared to the cost of that asset. If you would have received that same amount by selling the asset, you would have got the same gain. On that you would have paid tax. And if you are not paying the tax right now, it is not good, no? So pay tax right now also. But we are not going to tell you to pay the tax at the time of damage or destruction only. Because that 7 lakh rupees of gain is not happening at the time of damage or destruction. It is happening at the time of receipt of insurance claim. Understanding? So when the insurance claim was received? 25, 26. So the year in which the insurance claim is received, in that year the gain will realize. It will come in your hands. That time we'll charge the tax. Not before that. This year only the transfer has taken place. Only the asset is gone. Extinguishment of right has taken place. But this is not the year in which we are going to charge the tax. See, what if you would have received the insurance claim in the same year? Then we would have charged the tax in the same year because the gain is realized in the same year. But in my example which I have given, the gain is not realized in the year of damage or destruction, year of transfer. Gain is realized in the year in which the insurance claim is received. Did you understand? Hello? So first of all tell me, what type of asset you are having? Any capital asset. What type of asset you are having? Any capital asset. Can that capital asset be damaged or destroyed? Yes or no? Due to NRFE. Because of these reasons, your capital asset gets damaged or destroyed. And as a result of that, you are receiving what? If you receive your insurance claim, only then this charge will crystallize. Only then this charge will come into existence. What if you don't receive insurance claim only? Insurance company, rejected your claim. Did you get the insurance claim? 45(1) will not come only. What if there was no insurance of your asset? Asset got damaged or destroyed. There was no insurance. Are you going to get any insurance claim? So 45(1) will not come into picture till the time insurance claim is not received. The moment it is received, whatever profit or gain arising will be taxable under the head capital gain. But it will not be taxable in the year of damage or destruction. It will be taxable in the year in which the insurance claim is received. It will not be taxable in the year of damage or destruction. It will be taxable in the year in which the insurance claim is received. Did you understand? Now see, now you are supposed to charge this gain under capital gain head. Charge this profit or gain under capital gain. Now you will have to calculate this profit or gain. How will you calculate? Same format. Full value of what? Full value of consideration you are going to take? Asset is going, so full value of consideration, what is coming? The amount of insurance claim will be deemed to be your full value of consideration. You have to take this amount only as your full value of consideration. Yes or no? By taking this full value of consideration, amount of insurance claim as your full value of consideration, you are supposed to calculate your capital gain. That is what your section 45(1)(a) says. Understanding? So full value of consideration, amount of insurance claim. Yes or no? Now second thing. What if the insurance company, instead of giving you insurance claim in money, gives you asset? Oh, your asset is lost, no? Damaged or destroyed, no problem. Take this asset. So now also you are getting insurance claim, but you are not getting money. You are getting other asset in return. So the value of that asset is nothing but your insurance claim. Yes or no? That will be full value of consideration. So what did I say? The full value of consideration, what amount you are going to take? The amount of insurance claim. If money is received, then value of money received as your insurance claim will be treated as your full value of consideration. If some asset is received as insurance claim, then fair market value of the asset received is your insurance claim that will be treated as your full value of consideration. Yes or no? Hello? Now tell me, full value of consideration is done. Minus what? Transfer expense. There will be no transfer expense. You don't incur any expenses for damaging or destructing the asset. Yes or no? So there will be no transfer expense. Net consideration will be the same amount. Net consideration will be the same amount. After net consideration, cost of acquisition. What will be your cost of acquisition? In my example, 2 lakhs, the value, the cost at which the asset was acquired. But what if the asset was acquired prior to 1st April 2001? Fair market value as on 1st April 2001 or actual cost, whichever is higher. Yes or no? Any cost of improvement incurred will also be allowed as a reduction. For example, after purchasing the asset in 9-10 and before the damage or destruction in 23-24, improvement was done in 2016-17. Whatever cost of improvement was done, that cost of improvement also you reduce. Everything will be same. But only you have to be careful that now the capital gain you are calculating, you are not calculating on the normal transfer of the capital asset. You are calculating this capital gain on what? Receipt of insurance claim on damage or destruction of capital asset. Yes or no? So whenever there is a damage or destruction of a capital asset, whenever there is a damage or destruction of a capital asset, at that time when you will calculate your capital gain, please take the amount of insurance claim as your full value of consideration to calculate the entire capital gain. Everything else will remain same. Understood? Yes or no? Now one question I'll ask you. After reducing cost of acquisition, cost of improvement, everything, you will get what? Profit or gain? Capital gain. Short term or long term? Depends on the period of holding of the asset. Yes or no? Whether the asset is a short term asset or a long term asset. Yes or no? So tell me, from which date you will start the period of holding? Date of acquisition of your capital asset. Until what date you are holding that asset? Till the date of damage or destruction. Yes or no? So from the date of acquisition till the date of damage or destruction, that is the period of holding. Till the date immediately preceding to date of damage or destruction. Understanding? So your period of holding of the asset. Period of holding of the asset from date of acquisition of the capital asset till the date immediately preceding to date of damage or destruction. Because this is the date on which the transfer is taking place. This is the date asset ceases to exist. Your right in the asset is extinguished. This is the date. Yes or no? So if this period of holding less than or equal to 24 months, then the asset is short term. The resulting gain will be short term gain. If this date is if this period is more than 24 months, then the asset is a long term capital asset. The resulting gain will be a long term capital gain. Yes or no? Now I am creating one small example for you. You are going to solve this question. This is a question only which I am giving you in the form of example. You are going to solve this question right now. Okay? Pay attention. What name? Akshaya, no? Miss Akshaya acquired one capital asset on 12th of March 2009 for rupees 10 lakhs. For rupees 10 lakhs. Yes or no? Akshaya, at what price you acquired this asset? 10 lakhs. Sure, no? Did you incur any cost of improvement on this asset, Akshaya? Akshaya, did you incur any cost of improvement on this asset? Yes. Hmm? You don't know? Incur, no. Some cost of improvement also you will incur. Okay, no? So, she also incurred what? Cost of improvement of rupees 2 lakhs on 9th of May 2016. Okay. The above asset got damaged or destroyed due to natural calamities like floods, etc. Yes or no? Floods, earthquake, typhoon, cyclone. Yes or no? So, damaged or destroyed due to natural calamities on 15th October 2023, when its fair market value was 25 lakhs. She received insurance claim on this asset from the insurance company amounting to rupees 24,50,000 on 2nd December 2025. Compute capital gains, if any, from above details. Come on. This is your question. I want the answer from you. Wait up. How much? 12 lakh 50,000. Wrong answer. You have missed one very, very, very important thing. What cost of? So? No, 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 no. Don't try to create new provisions on your own, huh? Fair market value as on 1st April 2001. Huh? This is fair market value as on 1st April 2001. Did you acquire the asset prior to 1st April 2001? Then why are you applying all those things? You are missing very, very, very important point. Can you see the date of transfer? What is the date of transfer? Date of damage or destruction. Date of damage or destruction. Can you see that? What is that date? 1510? Meaning transfer. Date of damage or destruction meaning date of transfer is taking place prior to 23rd July 2024. And if the transfer takes place prior to 23rd July 2024 and the asset is a long-term asset, you have to do the indexation also. Indexation is not available if the transfer takes place on or after 23rd July. Yes or no? But here the transfer is taking place. I have deliberately taken that date. If I would have written this date, 15th October 2024, then your answer was correct. 12 lakh 50,000. Then your answer was correct. But I have deliberately taken that date, 15th October 2023, meaning the damage or destruction, meaning the transfer is taking place prior to 23rd July 2024. Now how will you calculate? Very simple, sir. First of all, see, I have a capital asset. Yes or no? I have a capital asset. That capital asset was acquired. Acquired on what date? Tell me. Date of acquisition. 12th of March 2009. Can I say previous year? Which previous year? Which previous year? 8-9, no? Previous year? 8-9. And it was damaged or destroyed, meaning transferred. Transferred on which date? 15th of October 2023, meaning previous year 23-24, and I will highlight this date. This date. And I'll write that is prior to what? 23rd July 2024. Yes or no? Prior to 23rd July 2024. Now tell me, can you see this period of holding? And tell me, this period of holding is more than 24 months. Therefore, capital asset is a long-term capital asset, and hence you have to compute what? Hence you have to compute long-term capital gain. And that long-term capital gain will be long-term capital gain under section 112, taxable at the rate of 12.5%. Yes or no? Okay. Now pay attention. To compute this capital gain, you are going to take full value of consideration. Now in the bracket usually we write selling price. But here if you write selling price, you are gone. What will be the amount of capital gain? Sorry, what will be the full value of consideration? Amount of insurance claim under section 45 1A, right? No. So amount of insurance claim under section 45 1A. And how much is that amount? 24 lakh 50. Taking this amount, I am supposed to calculate the capital gain. Okay, no? Minus what? Transfer expenses dash. And my net consideration will be same amount, 24 lakh 50,000. Minus what? Wrong. Indexed cost of acquisition. That is the reason why I have highlighted this. Now, how to do the indexation, you know that. First you take what? Cost of acquisition. What was the cost of acquisition of the asset? 10 lakh. Multiplied by CII. CII of which year? Transfer year. And which is the year of transfer? The year of damage or destruction. You can see from here, no? See, CII of which year? Year of transfer. Transfer year is 23-24 and divide by CII of acquisition year. Acquisition year is 8-9. So find out the CII of 23-24 from your textbook. Table is there. 348. This is the CII of the year of transfer divided by CII of the year of acquisition. What is CII of 9-10? 148. Now calculate. How much? 23,51,351. Everyone getting this amount? Sure or not? Less what? Index cost of improvement. So did you do any improvement? Yes. How much? 2 lakhs. And in the year 2016-17 that improvement was done. Yes or no? So 2 lakhs into CII of which year? Transfer year, meaning damage or destruction. Yes or no? So that will be same 348 divided by, now you will divide the CII of which year? 16-17, the year in which the improvement takes place. Tell me. 264. Tell me how much? 2 lakh 630. Calculate. You will get a loss. One lakh 980. Bloody, you were getting a gain of how much? 12 lakh 50. But there is no gain. It is long-term capital loss, which will be allowed as a set-off against long-term capital gains. Understood? Same question I am giving you for the second time. Now we will assume that the date of transfer was, date of damage or destruction was 15th October 2024. Then your answer would have been same, which you calculated. 24 lakh 50,000 minus 10 lakhs without any indexation now. Because the damage or destruction, meaning transfer, is taking place on or after 23rd July 2024. Yes or no? So if the transfer takes place on or after 23rd July 24, no indexation is available. Done, sir? Sure, sir? Okay. So now, if in the above question, the capital asset was damaged or destroyed on 15th of October 2024, then what would be your answer? Then what would be your answer? Same thing. Name of the assessee, individual, this, that. Okay. Same thing. You are going to write what? Full value of. First of all, you will write down this only. Same thing. Copy paste. So your capital asset is getting damaged or destroyed on 15th of October 2024, meaning previous year 24-25. That is on or after 23rd July. On or after 23rd July. Understood, no? Now computation of long-term gain. Same thing. What will you take? Full value of consideration. Amount of insurance claim. In the bracket only you will write all these things because you don't have to give a note later on. Understanding or not? Amount of insurance claim under which section? 45(1)(a), and that will be 24,50,000 only. Now the calculation will become lot easier. Less transfer expense, that is dash, nil. So same 24,50,000 will come as your net consideration. Done, sir? Minus cost of acquisition minus cost of improvement. So what was your cost of improvement, sir, and cost of acquisition? 10 lakhs and 2 lakhs. This will give you 12,50,000. That is your taxable long-term capital gain under section 112. On this you are going to pay tax at the rate of 12.5%. Yes or no? Now same question. Should I twist? Should I ask you something which I have already taught you? Few people will not get it who did not come, but I'm sorry for that. Okay. In the above question, if the capital asset was damaged or destroyed on what date? Same 15th of October 2024 only. I'm keeping that date same. But the capital asset was a building. Was a building. Compute capital gain and also the tax liability on such capital gain. Now this time they are asking you to calculate tax also, Hey, tell me one thing. In the question, see, this was the question, no? So you are computing the capital gains. This computation of capital gain is taking place in which year? The year of damage or destruction, meaning the year of transfer, is 23. But the computation and the taxability of capital gain is not taking place in 23-24. This is taking place in previous year 25-26. That is assessment year 26-27. In this year the capital gain is taxable. In this year the capital gain is taxable. Yes or no? Now tell me, in this case also, the capital gain, the transfer is taking place. Transfer is taking place in 24-25. Transfer is taking place in 24-25. Yes or no? On or after 23rd July. On or after 23rd July 2024. But I am not computing the capital gain in 24-25. Capital gain is computed and taxable in the year in which the insurance claim is received. So which is the year? Same, no? 25-26. So here also the computation and taxability of capital gain is taking place in previous year. Previous year 25-26. That is assessment year 26-27. Getting my point? Now tell me, in this question, when the capital gain will be calculated? 26-27. I have kept the same thing. This same question I have kept. Understanding? No change. Answer will also be 12,50,000. But a small information I have changed, additional information I have given, that in the same question which you have solved, yes or no, this, the capital gain was 12,50,000. But what if the capital asset was building, meaning an immovable property? So now your capital gain must also be calculated, which will be the same amount, yes or no? But what will be the tax liability on that capital gain? You calculate that tax also. Why I have given this, you know? You are an individual, resident individual. Capital asset transferred. Damaged or destroyed means transferred. On or after 23rd July. That capital asset was immovable property. If immovable property is transferred on or after 23rd July 2024, which was acquired prior to 23rd July 2024, and on that any capital gain will be calculated without indexation and will be taxable at 12.5%. But at the time of making the payment of tax, one option will be given. Recompute your capital gain by taking indexation, and on that you can pay 20% also. If you'll forget all these things now in the exam, gone. Have I told you this? Have I explained? Yes. So if I have told you, I have explained, this should immediately strike your mind that why sir has given this asset. Akshaya was an individual. If nothing mentioned, she is a resident. Okay? Resident individual. Which asset is transferred? Immovable property. When it is transferred? When damage or destruction taking place? On or after 23rd July 2024, meaning 15th of October 2024. And this immovable was acquired by her in the year 2008-9, meaning prior to 23rd July 2024. Now whatever capital gain is to be calculated will be calculated without indexation. On that she is supposed to pay tax at the rate of 12.5%. But if she will go and pay the tax, she will get one option also. Option to recompute the gain by taking the indexation, and on that she is supposed to pay tax at the rate of 20% also. Whichever is more beneficial. 12.5% without indexation, 20% with indexation, whichever is more beneficial, that she is going to pay. Understanding or not? So how will you present? If this information was given in the main question, what are you going to do? How will you solve the question? Come on, let's solve now. Did you understand the explanation? Everyone? Okay, now, name of the assessee? Miss Akshaya. Okay. Status? Individual. Dash? ROR. PAN? Akshaya, what is your PAN? Don't know, sir. Previous year? 25? 26. Assessment year? 26? 27. Can you see this previous year and assessment year? Why I am writing this previous year and this assessment year? Why I am calculating the capital gain in this year? Because the insurance claim is received in this year, hence this previous year and assessment year is coming. But the transfer is not taking place in this year. Transfer already took place in 2024-25 when the asset got damaged or destroyed. That time the extinguishment of right happened. Yes or no? Asset ceases to exist means the right in the asset also extinguishes. Got it? So tell me. Now computation of what? Computation of capital gains. To calculate this capital gains, first I will have to check which type of asset was there. Capital asset is a building. Capital asset is a building. When did you acquire? Acquired on 12th of March 2009, meaning previous year 8-9, and it was transferred. Transferred meaning damaged or destroyed, no? Damaged or destroyed. Date, very important, 15th of October 2024, meaning previous year 24-25, and also this is on or after 23rd July 2024. Now tell me, based on this, period of holding, can I say period of holding of the building is more than 24 months? Therefore it is a long-term capital asset. And now what type of capital gain I am going to calculate? Therefore LTCG shall be computed. Shall be computed. Now to calculate this LTCG, first of all, same thing, full value of consideration. Tell me what? Amount of insurance claim under section 45(1)(a). See, if you don't remember this section, no, 45(1)(a), then take some water, and take a dip in that water. That is more than enough for you. You have to remember. Okay? 45(1)(a). Tell me how much? Less transfer expense dash. Net consideration is nil, no? 24,50,000 net consideration minus index cost of acquisition, no? Index cost of improvement, no? Your capital gain calculation will happen without indexation only. But at the time of paying the tax, you will get the option to recompute that capital gain by taking the indexation. Yes or no? So cost of acquisition will be 10 lakhs. Cost of improvement will be 2 lakhs. Tell me how much? 12 lakh 50,000. This is long-term capital gain under section 112. In the bracket I will write without indexation. Without indexation. Now on this long-term capital gain, tax will be calculated at the rate of 12.5%. Calculate. $1,56,250. This is your cost tax. Cost amount of tax. Yes or no? Right, tax 1. This is your tax 1. You are going to do all these things only if the assessee is a resident, individual or HUF. Individual or HUF. In the case of immobile property, which was acquired prior to 1st April 2000, prior to 23rd July 2024 and which was transferred on or after 23rd July 2024. Yes or no? Only then you are going to do this kind of calculation, which I am going to do right now for tax calculation. Yes or no? So now I'll have to first calculate that same LTCG under section 112 with indexation. Now to calculate this LTCG, I will take same full value of consideration, amount of insurance claim, that was 24,50,000 less transfer expense dash. Net consideration will be 24,50,000 minus index cost of acquisition 10 lakhs. We have already done it in the first question. Yes or no? 348 divided by 148. See, this 348 is the CII of which year? This 348 is the CII of year of damage or destruction. Yes or no? So why are you taking 348? Then tell me. In the question which we have reframed, this is 15th October 2024. So the previous year 24, 25 is there, and by the way, for previous year 24, 25, 348 is not there. It is 363. So if you will copy paste from above, no, you are gone. Understanding or not what mistakes you are committing? So this will not be 348. This will be the CII of the year in which the transfer took place, meaning damage or destruction. In this example, the damage or destruction is not taking place in 23-24. It was in the first example, yes or no? But in my example, which I have changed, the transfer is taking place, damage or destruction is taking place on 15th of October 2024, meaning 24-25. So we have to take the CII of 24-25, which is not 348, which is, you have to be very careful about this CII. Huh? This will be known very soon, 148, but you have to be careful about this 363. Calculate now. $24,703. Okay. Now calculate the index cost of improvement also. Index cost of improvement 2 lakhs into transfer year CII 363 only, huh guys? Because the transfer, damage or destruction took place in 24-25. Divided by improvement took place in which year? 16-17. Yes or no? So what was the CII of 16-17? 264. That is going to remain same. So tell me how much? 2 lakh. Exact 275. Calculate. Negative 2,77,600. 703. Everyone got this, sir? Now this is what? Color, yellow color. LTCG without indexation. What is the LTCG without indexation? Negative, sir. Negative. It is not a gain, it is a loss. Now, this LTCG which you have computed without indexation, on that you are supposed to pay tax at the rate of 20%. So calculate 20% of this. Nil. Negative amount you will pay tax, meaning there is no capital gain. So 20% of no capital gain will be nil only, no? Because here you are not having any gain. Here you are having a loss. And on loss you are going to calculate the tax. Or on gain you are calculating the tax. Gain, no? If gain would have been here, I would have calculated 20% on that amount. So tax on long-term gain at the rate of 20%, but long-term gain is not coming, loss is coming, sir. So loss is coming, so don't pay any tax. As per 20%, you are not supposed to pay any tax. So tell me, this will be your tax 2. Tax 1 you calculated, no? And this will be your tax 2. So which one would you like to pay? Tax 1 you like to pay or tax 2 you like to pay? So therefore, tax on LTCG under section 112, which is lower of tax 1 and tax 2, which is how much? Nil. This will be your final answer. Now how much loss you are having? And you will set off this loss against the long-term capital gain. How much loss is there? 2,77,703. You will get 2,77,703 slabs if you will do that. This year you don't have a loss. This year you have a gain of 12,50,000. So even if at the time of calculating the tax liability you are having some loss, you are having this loss after taking the indexation. This is not the loss which is happening to you right now. This is just for the sake of calculating the tax liability. This loss is calculated. Otherwise you don't have a loss. You have to calculate your capital gain without taking indexation, and that capital gain will be shown as a part of your computation of total income. So in the computation of total income, are you going to show 12,50,000 or you are going to show 2,77,703 loss? Always 12,50,000. So you cannot say that you have a loss of 2,77,703 and you want to set it off. See how smart your government is. First of all, they removed the indexation also. Okay. Then they said that while calculating your capital gains, calculate the capital gains without taking in any indexation. Even if some loss would have been there, no, that loss because of that indexation will not be allowed as a set off. That is why smartly they have done that while calculating the tax only, we will recompute the gain by taking the indexation, so that if any loss also comes here, no, is not allowed as a set off. Because you cannot take this loss as a capital loss in the computation of your total income. In the computation of total income, you have already shown 12,50,000. That is your gain. Understanding? There you cannot go again, and there you cannot say that, see, I have a loss of 2,77,703. Give me the set off of this loss. No, not allowed. Understanding what I am trying to tell you? So a very important note will come here. Write down that note. IMP note. Important note. What note you are going to write? Important note, no? Long-term capital loss. Rupees 2,77,703. 703 shall not be eligible for any set off and carry forward. The same needs to be what? Fill in the blanks. Ignored. We are calculating your tax liability, so we are not taking any tax from you, but that does not mean that we are going to allow that loss as a set off or carry forward. That loss will be gone. Because this year you don't have a loss, you have a gain. Gain of how much? 12,50,000. On that, we were supposed to take 12.5%, but instead of taking 12.5%, we are giving you an option that recompute your gain by taking the indexation. And when you recomputed, loss came. That does not mean that loss we are going to allow you as a set off or carry forward. Forget about that loss now. Don't pay any tax now. Pay 12.5% or at the rate of 20%. How much is the tax? Nil. Pay nil. No tax we are going to charge. But that does not mean that this loss we are going to allow you as a set off or carry forward. Ignore this loss. Understood? This is a very important concept. 100% in your examination. If a question from capital gain will be there, 100% in that question, this is going to be there. This is going to be there. The question on immobile property will be asked. Capital gain to be calculated on immobile property, and on that capital gain, calculate the tax also. And this concept will be there in your question. Trust me on this. And if you will not solve questions like this, no? What if this happens? How my answer will change? What if this happens? How my answer will change? Okay, if you will not have this approach in capital gains, no? You will be gone. Because they can twist the question like anything. Understood? 45(1)(a) done. 45(1)(a) done. Now in 45(1)(a), tell me, period of holding. Did you see the period of holding? If the asset is short-term capital asset, no indexation from the date of acquisition till the date of damage or destruction. You came to know that the period is less than or equal to 24 months. Asset is short-term. Cost of acquisition, cost of improvement, no need to index. Because you never index if the asset is short-term. But what if the asset was long-term? You might have to index the cost of acquisition and cost of improvement if the transfer took place, meaning the damage or destruction took place prior to 23rd July 2024. But if the damage or destruction took place on or after 23rd July 2024, then no need to take any indexation. Without indexation, calculate the capital gain. And on that, pay 12.5%. But if that asset was immobile property, assessee is a resident individual or HUF, that immobile property was acquired prior to 23rd July 24 and transferred, meaning damaged or destroyed on or after 23rd July 2024, capital gain will be calculated without taking indexation. On that 12.5% tax has to be paid, but you get one option also to pay tax at what rate? 20% on the gains computed after taking indexation. But instead of gain, if there was a loss there, then that loss cannot be allowed as a set off or carry forward. That loss will be ignored. Understanding? Next one. How to index the cost of acquisition, how to index the cost of improvement? Simple. You will take the cost of acquisition multiplied by CII. CII of which year? Transfer year, meaning the year of damage or destruction. If you fall in this category, then your cost of acquisition and cost of improvement needs to be indexed, no? How will you index it? You will take the cost of acquisition, multiply the CII of year of transfer. And what is the year of transfer? Damage or destruction, divided by CII of year of acquisition. What if cost of improvement is there? How will you index it? You will take the cost of improvement, multiply CII of year of transfer, meaning the year of damage or destruction, divided by CII of year of improvement. Understanding? Now, the example which I have framed here. Okay, one more example is there. One more example I have framed here. Okay, solve this example. Come on. Similar type of example I have also solved. Don't worry. Okay, no. But instead of 8-9, the asset was acquired in 14-15. Instead of cost of improvement 2 lakh, cost of improvement is 1 lakh. Instead of insurance claim received 24 lakh 50,000, it is 24. Understanding? The same example I have taken, but with a different numbers. Understood? Should I move ahead? Okay. Now let's come to the next section. 45-2. 45-2. Any profit and gain. But before that, okay. One important thing I forgot to tell you. One important thing. See, for example, you have stock in trade. What do you have? Stock in trade. Can you take the insurance of your stock in trade? Can you take the insurance of your stock in trade? Stock in trade is your capital asset, no? Stock in trade is your capital asset, no? Or not a capital asset? Not a capital asset, sure. So can you take the insurance of this? Can you take the insurance of your stock in the business? What if the stock is damaged or destroyed by fire? Stock in trade, which is not your capital asset, for this stock in trade also you might have taken your insurance. What if this stock in trade is damaged or destroyed? Can this be damaged or destroyed? And on the damage or destruction, can you receive insurance claim? Can you receive insurance claim? What will be the tax treatment? Come on, tell me. Will you apply 45(1)(a)? Why? 45(1)(a) is applicable only if any capital asset is damaged or destroyed. Is it your capital asset? Will you apply 45(1)(a)? Will you take this insurance claim received under 45(1)(a) to calculate capital gains of stock in trade? But this insurance claim will be taxable under the head PGBP, as your deemed PGBP income against the loss which has taken place. So whatever stock in trade which was damaged or destroyed, can I say this is a loss in the course of business or profession, which is allowed as deduction under which head? Under the head PGBP. So this entire loss is allowed as a deduction under the head PGBP. Against this loss, whatever recovery is happening, insurance claim will be taxable under the head PGBP as your deemed PGBP income, if you remember. Deemed PGBP income under section 41(1). So if the question gives you an information that total 5 lakh rupees of stock lost by fire, how much stock lost by fire? So in your business, profit is happening, no? 5 lakh rupees. Loss of stock is a loss in the business. How much loss is happening? 5 lakhs. That 5 lakh will be allowed as a deduction under the head PGBP. But against that, now you are getting what? Insurance claim. That insurance claim which you are receiving is rupees 3 lakhs. So how much loss actually happened? 2 only. But you have taken a deduction of 5 lakh. So you'll have to reverse 3 lakhs now. Take that 3 lakh as your deemed PGBP income. If you will come in 45(1)(a) with this insurance claim, gone. This insurance claim cannot come in 45(1)(a) because this is not received on damage or destruction of a capital asset. Understanding? So since it is not a capital asset, sir, any insurance claim received will not come under section 45(1)(a), sir. Rather, that insurance claim will be taxable under the head PGBP as your deemed PGBP income, sir. Yes or no, sir? Second example. Huh? Any asset. Can I say building, furniture, plant and machinery, which was used for the purpose of what? Your business or profession. Can I say this asset can also be damaged or destroyed? This asset can also be damaged or destroyed. This asset is a capital asset or not a capital asset? Tell me. Asset or property of any kind, whether tangible, intangible, movable, immovable, fixed, circulating, whether used for business or not. Whether you are using that asset for your business or profession also, then also that asset is your capital asset only. So this is, sir, this is a capital asset. This is a capital asset, okay, no? This asset is a capital asset now. This asset was not a capital asset, but this asset is a capital asset, sir. Now this is damaged or destroyed, and the damage and destruction, you are receiving what? Insurance claim can be received here also. Insurance claim can be received here also. Now what are you going to do with this? Insurance claim received on damage or destruction of a capital asset, you have to bring it under section 45(1)(a). Yes or no? But don't bring it. Why? Because the assets which are used for the purpose of business or profession are shown under the head PGBP in what? In block. Yes or no? But if this asset is damaged or destroyed, meaning it is a deletion. Deletion from block. And against this deletion, this insurance claim will be adjusted from the value of the block. Bloody, if the amount is already adjusted under the PGBP head in the value of the block, why are you again charging it under the head? Capital gain. 45(1)(a), if you will charge this, the amount will be taxed for the second time, because that same amount is already adjusted from the value of the block as a deletion. So the assets which are there under the head PGBP in the block, if these assets are damaged or destroyed, meaning the assets are going out of the business, going out of the block, yes or no? So any asset which was there in the block under the head PGBP going out of the block, meaning deletion. And against that deletion, whatever amount is received, that amount you already adjust in the value of the block, yes or no? And if that amount is already adjusted in the value of the block, meaning to that extent you are not going to get depreciation, to that extent your PGBP income will automatically increase, then again you are, bringing this amount under the head capital gain, charging it under section 45(1)(a), one income will be taxed twice. You want to do that? So don't bring this amount under 45(1)(a), rather adjust this amount from the value of the block as what? Deletion. So whatever assets which are there in the business, they are under the head PGBP in the block. If these assets are damaged or destroyed, meaning there is a deletion happening from the block, and on this deletion whatever insurance claim is received, guys, this insurance claim received is nothing but this has to be adjusted from the value of the block. And since you have already adjusted as a deletion from the value of the block, hence it is not required to show under the head capital gain under section 45(1)(a). 45(1)(a) will not arise here also. Understanding, sir? Sure, sir. In the examination, no, they can twist your questions like this. The moment you will see insurance claim, you start jumping. Ayyo, 45(1)(a), 45(1)(a). Every time insurance claim coming will not result into 45(1)(a). It will be under section 45(1)(a) if the case is not this, if the case is not this, if the case is any other case. Can I say any other asset? Hello, sir? Any other asset which is a capital asset. By the way, this asset is not a stock in trade. This asset is not shown as a part of your block under the head PGBP. And this capital asset, if this is what? Damaged or destroyed. And on this damage or destruction, if the insurance claim is received, then this insurance claim will be treated as full value of consideration under section 45(1)(a) to compute your capital gain. Understanding? So 3 cases, very important case. This is the third case, this is the second case, and this is the first case. Please remember all these 3 cases, okay? So with this, 45(1)(a) comes to an end. Now we'll go to 45(2). Now we'll go to 45(2). 45(2). Sanjana, you have a capital asset, okay? So, this is our Sanjana, okay? So, this is Sanjana. Sanjana is having a capital asset. Let's say the capital asset which she is having is building. Is what? Any building which she acquired on 7th of August 2013. So Sanjana acquired capital asset. What was the capital asset, Sanjana? Building, okay. And this was acquired on 7th of August 2013, okay. Now this building was converted. This building was converted into stock in trade of business. Now see, initially when Sanjana bought the building, no, she bought the building as her investment, as her capital asset. She had money, she invested that money in the building. So that building was her capital asset. Now, on 15th May 2024. 15th May 2024, Sanjana is starting a business of dealing in properties. immobile property. Can she start that business? Can she start that business? Yes or no? Any assessee can start any business. So she wanted to start a business of dealing in properties. She became a property dealer. On what date? 15th of May 2024. So now in her business, she will have to buy the properties as stock in trade. Yes or no? But she already had one property which she converted as her stock in trade in the business. Can she do that? So when she started that business, in that business of selling the properties, so now the properties she is going to sell as stock in trade. She is going to sell a stock in trade. What stock in trade she is going to sell? Buildings, means properties, immobile properties. Yes or no? She'll buy and sell. She'll buy and sell. What? Immobile properties. Properties, buildings, etc. Now when she becomes a property dealer, no, so she thought that see, few properties I am buying as my stock in trade, but one property already had as a capital asset. Why not to make this property also as a stock in trade in my business? So on 15th of May, the date on which she started her business, no, on that same day, she brought this property in her business as what? Stock in trade only. Understood? Now on this day, see, she acquired the building and the actual cost of that building was 5 lakh rupees. How much? And at the time when she converted this building into stock in trade, no? At the time when she converted into stock in trade, at that time the fair market value as on the date of conversion. So this is the date of conversion, and as on this date the fair market value of this building was, let's say, 20 lakhs. How much? 20 lakhs. Now what is she having? What is she having? Same, no, the capital asset which she was having, building she was having, that same building is held by her as stock in trade now. Now that stock in trade she is going to sell. Okay. What she sold? Stock in trade. See, the stock in trade was the building. Which building, sir? This same building she converted into stock in trade. Meaning this stock in trade is the same building. Yes or no? And that same building which she has converted is now that same building is sold as what? Stock in trade. What she is selling, sir? Same building. But same building is sold as stock in trade. Now when she is selling it, let's say she is selling it on tell me any date now. From 25, in 25, 26, any date you want. 15th? Tell me any date now, come on, you cannot tell the date also. So dumb. Any one date, come on, tell me. 18th August. 18th August 2025. At what price she is selling? Come on, tell me. Any one of you. 30 lakhs? Very good, wonderful. The selling price was 30 lakhs. Sanjana, you acquired one asset for how much? And you are selling that same asset for how much? Are you getting a profit of 25 lakhs? Yes or no? How much profit she is having? 25 lakhs. But don't you think that profit cannot be taxed under the head capital gain? Why? Because she is not transferring that asset as capital asset, she is transferring that asset as. So since she is transferring the stock in trade, now at the time of transfer of stock in trade, capital gain income is not calculated, sir. What is calculated? PGBP income is calculated, yes or no? So when she transferred, tell me. When she transferred 25, 26. So can I say previous year 25, 26, she is transferring the stock in trade. This is the year in which the stock in trade is sold. This is the year in which Sanjana is going to calculate her PGBP income. Sanju, tell me for how much you have transferred? Tell me, bacha. For how much you have transferred? 30 lakhs, no? So to calculate the PGBP income, PGBP means profits or gains. Profits or gains. She'll take what? Selling price. Selling price of her stock in trade, which was how much? 30 lakhs. Out of the selling price, she is going to calculate the profit. So she'll have to reduce the cost of this building. Yes or no? What was the cost of this building, sir? 5 lakhs. So she will reduce 5 lakhs cost. How much is the profit, sir? So PGBP income will be 25 lakhs. Okay. Tell me, is this calculation correct? To calculate the profit, I need to take selling price of stock in trade minus the cost. So what was the selling price? 30. And what was the cost of this building? 5 lakhs. So selling price minus cost is going to give me profit, and that profit is 25 lakhs PGBP income. Yes or no? Correct or not? Not correct? Just because I have asked you questions, it is not correct. Tell me, if it is correct, then no problem. I'm not going to ask you anything. But if it is not correct, then tell me what should be the correct thing. Sanjana, if you have this asset and if you will sell it, the assessing officer tells you to pay tax on 25 lakhs. Are you ready to pay tax on this 25 lakhs? Yeah, sir. What is the problem in that? I bought the asset for 5 lakhs. I sold it for 30 lakhs. 25 lakhs rupees is profit. On that profit, I'm supposed to pay tax. Yes or no? Wrong. He is charging this profit of 25 lakhs under the head PGBP. Don't you think in this 25 lakh rupees of profit, some profit relates to this period? When Sanjana was holding that asset as a capital asset, any appreciation in the value of capital asset cannot be taxed as PGBP. It has to be taxed under the head. And if the assessing officer is telling her to pay tax on 25 lakhs, it is wrong. Because from here to here, appreciation in the value is how much? Appreciation in the value is 15 lakhs. Yes or no? And this is the appreciation in the value of capital asset. And from here to here, for this period, wait, just shift it a little bit down. Okay. From here to here, what was the profit? Come on. For this period, what is the appreciation? 20 to 30, appreciation of 10 lakhs. Now, if you see, this 10 lakh is the appreciation in the value when she was holding the asset as a stock in trade. After the asset got converted into stock in trade, for the period for which she is holding stock in trade, for that period the appreciation is 10 lakh. That 10 lakh is realized because she has sold the asset. And don't you think this 15 lakh will also be realized when the asset is sold? Total gain realized is how much? 5 lakh out of 30 minus 5. Total gain realized will be 25. But in that 25 lakh rupees of gain which is realized right now on sale of the asset, don't you think 10 lakh rupees of gain which is realized right now is relating to that period for which she is holding asset as a stock in trade? And out of that 25 lakhs, 15 lakh rupees of the gain realized right now is the gain related to the period for which he was holding the asset as a capital asset. So out of the total 25 lakhs, this 10 lakh is for the period for which the asset was held as stock in trade, and out of the 25 lakhs, this 15 lakhs is the profit for the period for which the asset was held as. Bloody both the profits are getting charged under the head PGBP. How can you charge the profit relating to the period for which I am holding the asset as a capital asset under the head PGBP? Who has given you the right to do that? Sanjana started fighting with the assessing officer that AO, if you are charging this 25 lakhs under the head PGBP, I don't mind paying tax on gain, but at least don't charge the full 25 lakhs under the head PGBP at normal rates. Because PGBP is taxable at what rate? Normal rates. Do you have some mind, assessing officer, that out of this 25 lakhs, some profit is relating to that period for which I was holding that same asset as my capital asset prior to its conversion? And prior to the conversion of that asset, when I was holding that same asset as a capital asset, whatever appreciation for that period which I have realized as a gain right now should not be taxable as my PGBP income. If you are reducing 5 lakh rupees as my cost, what is happening? The gain for the entire period getting taxed under the head PGBP, which is wrong. Under the head PGBP, if you charge 10 lakh, that is logical and that is acceptable also. But under the head PGBP, if you are charging 25 lakhs fully, is illogical and completely unacceptable. I don't want to pay tax on that 25 lakhs entire realized gain under the head PGBP. But definitely I'll pay tax on 10 lakhs under the head PGBP. Now she is talking logical things. So the assessing officer said, no problem, the remaining 15 we will charge under the head capital gain. But to do that the remaining 15 lakh gets taxable under the head capital gain, the definition of transfer is amended. The term transfer also includes what? Conversion of capital asset into stock in trade. So the moment your capital asset gets converted into what? Stock in trade, that conversion is also treated as transfer. When the conversion took place? When the conversion took place. So that conversion is also treated as what? Transfer. And any profit or gain arising on this conversion, meaning this amount, will also be treated as your income under the head capital gains. So that under the head PGBP, instead of 25, how much should be taxed? 10 lakhs. Yes or no? And under the head capital gains, how much should be charged? 15 lakhs. But to do that, here the cost cannot be taken as what? Here the cost cannot be taken as 5 lakhs. And just try to apply some logic. You are calculating PGBP, no? To calculate PGBP, out of the selling price of stock in trade, how can you reduce the cost of capital asset? You have to reduce the cost of stock in trade, no? And this 5 lakh was not the cost of stock in trade, it was the cost of capital asset. Understanding? So to calculate PGBP, this cost cannot be taken. How much cost should be taken? The fair market value as on the date of conversion will be deemed to be the cost of your stock in trade. Will be deemed to be the cost of your stock in trade. So to calculate this PGBP income, your, just a second, this 5 lakhs cannot be taken as your cost of stock in trade. Instead of that, you are going to reduce how much? The fair market value as on the date of conversion. As on the date of conversion. What was that? 20 lakhs. Reduce this. So therefore your PGBP should not be 25 lakhs. It should be 10 lakhs only. Understanding? This is more logical to do. Sure, sir. Now have you calculated the PGBP? First of all, tell me, how much gain is getting realized? 25. Out of that 25, 10 lakh will be taxed under the head PGBP. But to calculate this 10 lakh, here compulsory you are supposed to take cost of stock in trade as what? Fair market value as on the date of conversion. Okay. Now, whatever balance 15 lakh is there should also be taxed. When it will be taxed? In the year of conversion. In the year of conversion, that 15 lakh is realized, or that 15 lakh will be realized at the time of sale of stock in trade. So that 15 lakh should be taxable in the year in which the stock in trade is sold. Because the year in which the stock in trade will be sold, in that year, entire 25 lakh gain will be realized. 10 lakh PGBP gain will also be realized in that year, and 15 lakh capital gain will also be realized in that year. So that capital gain, 15 lakh should be taxable in the year of conversion, transfer, no, in the year of sale of stock in trade. So when did you sell your stock in trade? Tell me, 25-26. So in the year 25-26, will you realize the entire 25 lakhs rupees of gain? Yes. Out of that 25 lakh rupees of gain, how much will be taxable under the head PGBP? 10 lakh. And how much should be taxable under the head capital gain? 15 lakhs. So now in this year, you are going to make one statement, one more statement. Statement to calculate your capital gain. And now this capital gain will be calculated under section 45(2). Capital gain on conversion. So till the time of conversion, whatever gain was there, that gain should be now taxed in this year under the head capital gain. So initially entire 25 lakh was being charged under the head PGBP. No, this will not happen. Under the head PGBP charge only 10 lakhs, and the remaining 15 lakh realized gain you charge under the head capital gain under section 45(2). But this will not be taxable in the year of conversion, because in the year of conversion this 15 lakh rupees gain is not realized. This will be realized in the year of sale of stock in trade. In that year the capital gain will be calculated and will be taxable. Understanding? But to calculate this capital gain, you need to follow a process. First, full value of, tell me, what should be the full value of consideration? To charge this 15 lakhs under the head capital gain, cost of the asset is 5 lakhs. So what should be the full value of consideration? 20 lakhs. Now don't you think this 20 lakh has double role? Double role movies are there, no? One hero, two role. So hero is fair market value. As on the date of, this fair market value will be treated as cost to calculate your PGBP income. And the same fair market value will be treated as your full value of consideration to calculate your capital gain. Take this amount as your full value of consideration minus the cost of capital asset. 15 lakh will be chargeable under the head capital gain. But that 15 lakh will be taxable in the year of conversion only, no? Transfer only, no? Or any other year? Will be taxable in the year in which the stock in trade is sold, because this 15 lakh will also be realized at the time of sale of stock in trade. So should be taxable in the year of sale of stock in trade. Yes or no? What will be the period of holding of your capital asset? Sanjana, from which date to which date you are holding capital asset? This is the period of holding of the capital asset. This is only the period for which the capital asset is held. After that, capital asset is not held. After that, the asset becomes stock in trade. Now for this period, what is held? Stock in trade. So don't take your period of holding from here to here, otherwise you will be gone. Period of holding of the capital asset will be from the date of acquisition of the capital asset till the date immediately preceding to date of transfer, meaning date of conversion. So when the conversion took place? So from 15th it is a stock in trade. So it was a capital asset till 14th of May. So your period of holding will be from this date to this date. Understanding? Don't extend your period of holding beyond that. After that, what are you holding? Capital asset? No, only stock in trade. Now, if you see this period of holding and you come to know that the period of holding is less than or equal to 24 months, then the gain will be short-term gain and cost of acquisition, cost of improvement will be without indexation. But what if you see this period of holding and you come to know that the period of holding is more than 24 months, then the asset is long-term, and in the case of long-term also, indexation is not available. Resulting gain will be long-term gain. Yes or no? But for that, the transfer should take place on or after 23rd July. Conversion should take place on or after 23rd July 2021. In my example, conversion is taking place prior to 23rd July, sir. Asset is long-term. And the conversion, meaning transfer, is also taking place prior to 23rd July. Asset is long-term, transfer is prior to 23rd July. Cost of acquisition, cost of improvement, both must be indexed. So what will be your cost of acquisition? This much. Hello? Multiplied by CII. CII of which year? CII of year of transfer. When your capital asset was transferred? 24-25. So take the CII of 24-25 divided by CII of year of acquisition. Take the CII of 13-14. Any cost of improvement incurred? Yes. If the cost of improvement would have been incurred, then this gain would have also been reduced. Understanding? So let's take one example. In the same question, cost of improvement of rupees 1 lakh was also incurred in previous year 18-19. Which year? And one cost of improvement was also incurred. Cost of improvement of rupees 1 lakh was also incurred in the year on 11th December 2024. 11th December 2024. Understanding? So now tell me, what was the cost of improvement incurred on 11th December 24? Cost of improvement of rupees 1 lakh is also incurred on 11th of December 2024. Tell me, 11th December 24 meaning prior to conversion or after conversion? So when you will calculate your PGBP, that time this cost of improvement will be considered to calculate your PGBP income. Yes or no? But when you will calculate your capital gains, to calculate your capital gains, this cost of improvement will be considered. This one. Yes or no? Now because of this, your profit will reduce. By how much? This will also reduce by 1 lakh. It will be 14 lakhs. Yes or no? And this will also reduce. This will be 9 lakh. Understanding? So now tell me. First of all, I am giving you the question. This is the question which I have framed. Okay. So tell me, in this year, what is the appreciation from this period to this period? First period, tell me. Asset's cost was 5 lakh. You incurred improvement of 1 lakh. And that asset, the fair market value was 20 lakhs. So meaning, what is the appreciation? 15 lakhs? No, it is only 14 lakh because you have to consider cost of improvement also. Yes or no? So appreciation in the value is 14 lakhs. This 14 lakhs will be taxable under the head capital gains. And here the appreciation is from 20 lakhs plus 1 lakh, it became 30 lakhs. So 30 lakh minus 20. 30 lakh minus 20 minus 1. This appreciation is 9 lakhs and this should be taxable under the head. Under the head PGBP. Now both these appreciation will be taxable in which year? Will be taxable in which year? The year of conversion. In that conversion year, you will calculate your capital gain also. So this PGBP also. No. Conversion year you ignore. On conversion, whatever gain is happening, and afterwards also whatever gain is happening, entire gain you realize in which year? The year in which this asset was sold as stock in trade. So in that year, both the gains will be taxable. So in that year, you will prepare two statements. How many statements? One statement to calculate your PGBP income. In that statement, you are going to calculate your business income, PGBP income, and another statement to calculate your capital gain as per 45(2). So 45(2) says that any profit or gain arising on conversion, any profit or gain on conversion of capital asset into stock in trade, that entire profit or gain will also be taxable under the capital gain only as per 45(2). But that will be taxable in the year of conversion? No, that will be taxable in the year of sale of stock in trade. Yes or no? To calculate that capital gain, what will be the full value of consideration? Whenever you will calculate the capital gain in the year of sale of stock in trade, you will calculate the PGBP income also, you will calculate the capital gain also, capital gain under section 45(2). Since it is realized in the year of sale of stock in trade, to calculate that capital gain, what full value of consideration you are going to take? This fair market value as on the date of conversion, will be deemed to be the full value of consideration to calculate your capital gain under section 45(2), and it has a double role. This will also be treated as cost of your stock in trade under the head PGBP to calculate your business income. So this 20 lakh has double role. Please remember, the fair market value as on the date of conversion will be treated as cost of stock in trade to calculate your PGBP income, and the same amount will be treated as your full value of consideration to calculate your capital gain under section 45(2). Will you be able to calculate the capital gain and PGBP based on this example? Question only I have presented in the form of example. Yes or no? Solve and give me the answer. Come on. Solve this question and give me the answer. Instead of writing the question like this, no? Hello. Instead of writing the question like this, I have presented the entire question in the form of this diagram. That's it. All these information will be given in the question. I have just arranged that information in the form of this diagram. Okay? Solve and give me the answer first. Should I start? Okay. See. Name of the assessee? Sanju. Miss Sanjana. Status individual ROR. PAN dash. Previous year 25, 26. Assessment year 26, 27. Computation of what? First of all, we'll compute here, we'll compute the PGBP income. Computation of PGBP income. Tell me, to compute the PGBP income, we need selling price of what? Stock in trade. What was the selling price? 30 lakhs. Less cost of stock in trade and any cost, other cost of improvements also were incurred, no? So what was the cost of your stock in trade? Here you are supposed to take the fair market value as on date of conversion. As on date of conversion. Date of conversion, what was the fair market value? 20 lakhs. And after conversion took place, was there any improvement made? Yes. This is the cost of improvement of your stock in trade, huh? Not your capital asset. Cost of improvement of capital asset will be reduced while calculating the capital gains. So this was how much? 1 lakh. So now tell me how much? 9 lakh will be taxable under the head PGBP. This is one calculation, okay? Now second calculation we are going to compute. Computation of what? Capital gains. And this capital gains we are calculating under section 45(2) on conversion. Yes or no? So capital gain on conversion will also be taxable right now in 25, 26 because the stock in trade is sold in 25, 26. So for this, full value of consideration. What is the full value of consideration? Same. Fair market value as on the date of conversion. Yes or no? So we are going to take this same amount. Fair market value as on the date of conversion. But from this fair market value, we are going to reduce what? Less transfer expense. Any expenses on conversion taking place? No. Then net consideration will be 20 lakhs. Now from this we are going to reduce what? Weight. Now first of all, let us see what was the asset? Building. When it was acquired? 7th of August 2013. And when it was converted? 15th May 2024. So from this date till this date, the capital asset is held. So this is the holding period. Now check this holding period. Depending on this holding period, we have to decide whether the asset is a long term or a short term. Period of holding is more than 24 months. More than 24 months. Hence the asset is long term. So we are going to calculate the long term gains. But to calculate this long term gain, cost of acquisition, cost of improvement will be reduced. But we'll have to index that also because the conversion meaning the transfer is taking place prior to 23rd July 2024. Okay. So here what are we going to do? We are going to take the index cost of acquisition. What was the cost of acquisition? 5 lakhs. Into CII of which year? Transfer year. Transfer meaning conversion year. In which the year the conversion took place? 24, 25. So CII for that was 363 divided by CII of year of acquisition. When the acquisition was when the asset was acquired? 1314. So CI of 1314 will be 220. What is the final amount? 8,25,000. Everyone got this? Less what? Index cost of improvement. Cost of improvement was 1 lakh multiplied by CI of year of conversion, meaning year of transfer, that is 363, divided by improvement happened in 1819. So divided by CI of 1819, 280. How much is this? 640. Everyone got this? Calculate. 45, 357. This is the long-term capital gain. Taxable long-term capital gain under section 112. This will be taxable. Okay, no? Now, calculate the tax also. Calculate the tax also. Sir. Transfer took place prior to? Transfer took place prior to 23rd July. So on that, 20% tax was applicable. Because the capital asset is transferred prior to 23rd July. At that time, indexation was also available and the gain is calculated by taking the indexation. On that gain, earlier, how much tax was supposed to be paid? 20%. That tax is to be paid now. Understanding? But wait. If the transfer is taking place on or after, meaning the conversion is taking place on or after 23rd July 2000, this entire capital gain will be calculated without indexation. On that you will pay 12.5%. Yes or no? And wait, you will also recompute the gain by taking the indexation. Now write down. In the above question. Sorry, what would be the tax liability in above question? So first you will have to calculate the tax liability. Assuming that there is no other incomes and no deductions, etc., what will be your total income? Your total income will be capital gain as well as this PGBP income. Yes or no? So first you will have to calculate the total income, and on that total income you are going to calculate the tax liability. Understanding or not? So tell me, here, total income. The total income will be, guys, in that total income, your PGBP income will also come, which was 9 lakhs, and plus LTCG under section 112 will also come, 10 lakh 45,357. Yes or no? Now this will give you gross total income of 19 lakhs 45,357 minus chapter 6A deductions. Any chapter 6A deductions? No chapter 6A deduction, meaning your total income will now be 19,45,357. On this total income you are supposed to apply the tax rates. Now here assumption 115 BAC followed as well as 115 BAC not followed. First of all assume 115 BAC not followed. Then we'll assume 115 BAC is also followed. Yes or no? So on this total income, if I calculate the tax, so can I say tax on LTCG under section 112? How much was the LTCG? 10,45,357 at the rate of 20%. Directly I will apply 20%. Why? Because the gain we have calculated by taking the indexation and the asset was transferred prior to 23rd July 2024, no? Yes or no? No. Even if you have taken the indexation, that gain is taxable in this year, guys. The gain is taxable in. So whenever the gain will be taxable in this year, what will be the rate? 12.5% only. Understanding? So instead of 20%, you are going to take 12.5% only. Because if the capital asset, if the gain, right now the gain, the rate of long-term gain tax is how much? 12.5%. So you have to apply that 12.5%. Calculate 12.5. 1 lakh. But wait, your total income, no, you have not rounded off. So first you will have to round off. 19,45,360. Okay, no? And you take your capital gain as 360 only. On this 360, calculate 12.5%. Come on, tell me. 1 lakh. 30,000. 670. Everyone got this? Now on this, tax on balance total income. Balance total income was 9 lakhs. At what rate? At normal rates. What is the tax at normal rates? Come on, tell me. First 2 lakh 50. No tax. 2 lakh 52. 5 lakhs. It is 12,500. 5 lakh to 9 lakh. 5 lakh to 9 lakh. On 4 lakh, you are going to pay 20%. That will be 80,000. So this will be 92,500. Add both of them. 2 lakh 23,170. And will you apply any surcharge? No. Why? Because your total income was not more than 50 lakhs. Will you add any cess? Sorry, will you reduce any rebate? No, because your total income is still still more than 5 lakhs. Okay, no? So no surcharge, no rebate. Add only 4%. Add 4% and give me the final answer. 32,097, and I will have to round off this also. This will be rounded off under section 288B. Tax is rounded off under section 288B. 2,32,100. 3 rupees more. Understood? In that same question, if they are telling you to calculate the tax liability as per 115 BSE, what are you going to do? LTCG tax will not change. Only your tax on balance total income will now be. Here the tax will be as per 115 BSE. Okay, no? So this tax will change. This tax will change. Yes or no? So this amount will change. And add 4%, this amount will be changed. Okay? So it will be rounded off under section 288B. The change will happen only in the tax applicable on balance total income. For first 4 lakhs, no tax. 4 to 8, 5%, 20,000. Yes or no? And then remaining 1 lakh, how much? 10%. So 30,000 tax will come. So here it will be 30,000. And this will be 1,60,670. On that apply 4%. 167,097. Again rounded off. 167,100. Understood? Will you be able to do it? So we are not solving according to that. Okay, no? Now in that same question, in the above question, in the above example, what if date of conversion was 16th December 2024 instead of 15th May 24. Will your answer change? Your capital gain will also change and your tax liability will also change. And now, wait. This will be going for your homework. This is going to go for your homework. Okay, no? Now what are you going to do? Come on, tell me. See, pay attention. Same. Name of the assessee and everything. PGBP income will not change. It will remain same. Yes or no? Will you calculate the capital gain in the same manner or it will change? Now it will not be indexed. 5 lakh will be reduced here. 1 lakh will be reduced here. So out of 20 lakh minus 5 lakh minus 1 lakh will be 14 lakh. So now your capital gain will be 14 lakh. Taxable at what rate? 12.5%. Now you will have to again recompute the gain by taking the indexation. Recomputed gain on that 20% and without indexation on that 12.5%, whichever is lower. That tax you have to pay on long-term gain. And on balance total income, the tax remains same. Will you be able to do that calculation? Do that calculation and give me the answer tomorrow. Okay? So this thing I am keeping pending for you. This thing I am giving you as a homework. Okay? So this will be your homework. Do it positively today itself. And if you are not doing it, not giving me the answers, not reminding me to discuss this, that is your loss, not my loss. I know everything. You don't know. Okay? So take a small break, 40 minutes. After that we are meeting and we'll continue from here. Okay?